All good. Thank you, guys. Much appreciated. So what's up with the euro, huh? It's been going up nicely for a while for the first part of this summer, chopping like crazy for most of August. And suddenly this week, out of nowhere, decided to take a dive. Well, what if there was a way to predict some of these turning points? As a matter of fact, most of these turning points, as well as the very top and the bottom where we currently find ourselves. Well, there is. Good news. And I'm going to show you exactly how it works step by step. Those of you that have been coming to this class, you know I've been following EU with you for a while. I've been talking about a target at 33.79 for a couple of weeks now. We'll review how we got there. For those that are new, I'll show you step by step with how we arrived at that target. And 2 weeks ago, we also made a prediction about what's coming next. That just came true today. And I'll show you guys how we came up with that as well. And Euro's not the only one, by the way. Gold completed a very nice fib this week as well. We're going to take a peek at that one as well. And Mike, that's exactly what I'm going to show you. You know, when it first started dropping, you'd think something were up with Greece again, or maybe Spain. Purely technical levels. Well, Syria is another story, Forex Gal. And Egypt as well. Certainly been having their influences on oil prices this week. But here again, it's just weird. Maybe the news causes the turns. But the prices they happen at aren't random. And that's the beauty of this. There really is a pattern going on once you learn to recognize it. Let me show you how it works. First of all, if we're trying to predict the top, how high is this thing going to get before it turns around and goes down? In other words, you're trying to predict the length of the uptrend. Well, all you got to do is measure the uptrend that preceded it. Okay? And it's pretty easy to see the point where this up move began and the highest point we reached before we had our first major pullback. Right? Pretty easy to spot on this chart. So let's go ahead and mark those 2 points. I'm going to mark them point A and point B. Not terribly creative, I know, but it works. Okay. A is very simply where the up move began. B is the furthest point reached before we had a pullback. I'm going to grab my Fibonacci tool, you guys. I'm going to go down by the bottom of the wick by point A. And actually the red one's a little bit longer than the green one. I'm going to hold my mouse button down. I'm not letting go. And I drag up to the top of the wick by point B. Okay, now already you should be kind of looking at this. Look at the major reversal points along the way. look and see where we formed the top. Look where we came back down to. And I hope I've got your attention. It was worth it to go to one more webinar before you started your weekend. Wasn't it? Date of point A, Forex Gal, let's see, around the 10th of July, maybe a little bit earlier. I can find out exactly for you. 9th of July. And point B in this case was 3 days later than on the 11th of July. Could be. Markets are open Sunday night. Yeah, July 9th. That's what the meter's showing. How's it going, Drew? Welcome to the party. Alrighty. So we marked 2 points, you guys. The Fibonacci tool gave us a couple lines in between. And already we're thinking there must be something interesting going on. I hope. Okay, let's dig a little bit deeper into what you're seeing here. You'll notice point B, where I let go of my mouse, is marked at 0%. And by the way, remember, I'm measuring wick to wick. The reason for that is distance. Right? If you want to find out the distance of something, it makes sense to measure from the furthest point to the furthest point. It's not like in our Wednesday class when we draw trend lines. Trend lines, we're interested in market consensus. So we connect the bodies. For example, if I wanted to know, is this uptrend really over? Well, in an uptrend, I connect the bottoms, you see, going by the bodies. The point at which we cross the trend line, the uptrend's over. You can do the same thing in reverse. If you want to know when a downtrend is over, connect the last two tops. Okay. Again, going by the bodies. When the trend line breaks, you know something new is going on. Okay, so trend lines, market consensus, we go by the bodies. Fibs, we're measuring distance, so we go wick to wick. But the very next thing I do after I draw my fib, I just sit back and observe how price behaves. Because I've only got control over those 2 points, A and B, where the fib starts and ends. Right? The in-between lines will fall where they will, according to the Fibonacci formula. When I notice that price is treating the in-between levels as important, in other words, something's happening at those price levels, and that can be a body or a wick, but I just want some acknowledgement that these Fibonacci levels are important to the rest of the markets, not to just me. I call points like this, like the top of this red candle, snaps. Okay, in this case I didn't have to wait very long. The very next candle validated the fib. Though there's others. You know, look at these bodies. Not in random space. Look at the top of this green wick here, or the bottom of this green wick here. Okay, this validates my fib. Now, if I don't notice any snaps, and I get a lot of stuff dangling off in empty space, a little bit is okay. If I don't get any acknowledgement that these in-between levels are important, all I do is simply try another fib. MetaTrader, it's very easy to do. I'm sure your trading platform has some variation of it. But there's usually a line that shows up connecting A and B, reminding you how you drew your fibs. This red dotted line. Just double click on it, and you get these little white squares at each end. These are control handles. Click, drag, and you instantly adjust your fib. Not bad, but I'm not seeing as many snaps. I guess more market participants are aware of this one. Snaps can be a body or a wick, Boyke, either or. Just this one's the top of the wick, actually, on this red candle. This one's a wick, this is bodies, either or. Just some acknowledgement from the markets that these levels are important. So once I've drawn my fib, done a visual check for snaps, adjusted if need be, next thing I need is point C. Point C is how far back towards A we retrace. Okay, because notice, as we move from 0, 0 is point B, where I let go of the mouse. As I move from point B towards point A, the numbers count up. These are percentages. Okay, so 50%, let's move over, in theory, would be halfway between A and B. Right? That look about right? It's about halfway between A and B. It's actually exactly halfway. Okay? So these are the Fibonacci retracements. And the thing when we're counting retracements, you guys, it's not like you're used to doing in math where you round off to the nearest number. Okay? I'm interested in the last level that was actually touched or crossed. Doesn't matter how close to 50 we came. The last of the levels that was actually touched or crossed, or in other words completed, was the 38.2. Or in other words, a third of the way between B and A. So we're going to label that point C. Alrighty? And basically, Fibonacci boils down to this. Measure A to B, sit back and observe where C is, trade C to D. And there's some very simple to remember rules for determining where D is based on your C. And I think you're starting to see why Fibs work so well. It's not voodoo. It's not hocus pocus. Right? It's not some magic indicator. The reason they work so well, you guys, is that they're relative. A smaller move will have A and B closer together. So the in-between levels will be closer together. A wider move will have A and B further apart, so these levels are wider apart. And besides that variable, C can be different in any number of different situations. So you measure the relative width of what came before, and then you measure the counter move. You have a tool that is always adapting to the current market situation. That's why it's so accurate. It's not magic. It's an adjustable tool. And you've just made it fit to the situation. Okay? And by measuring what has come before, you can make some fairly accurate predictions about what's coming next. Yes, I know the markets aren't predictable. But the secret is, you guys, people, particularly when they're acting in large crowds, you know, the herd mentality, are very predictable. And some of the things we've learned and observed over the years, you guys, when the retracement at C comes to 38%, not 100% of the time, nothing in trading ever is, but most of the time, okay, enough to be a tradable edge, we're talking around 75 to 80% of the time, 38 will go to 138. A retracement of 50% will go to 161. And a retracement of 61, much more often than not, also ends up at 161. Okay, these are the three you're going to see the most often. And they have the highest probability of success. Now, when you don't complete a fib, it just means that you had a reversal somewhere ahead of D. It doesn't necessarily mean that you're going to have a losing trade, mind you. Not once you've got some practice in spotting reversals. It just means you might have to get out for less profit than you were originally hoping for. Maybe it'll be a smaller profit. Maybe it'll be break even. That's up to how well you manage the trade. It doesn't necessarily have to be a loss. Okay, so when I say 75 to 80% of the time, I mean C going all the way up to D. If you have to bail out early, you bail out early, but that usually happens the minority of the time. And usually due to something else, a new piece of news hitting the market or something. So what about some of these other levels, 78, 86? Well, they happen less often, you guys, but we've got movement rules for those as well. And there's a document you can download from the link that I just posted that'll explain all of the C to D movement rules. But again, start out with these three. Okay, if you're new to Fibs, start out looking for and trading these guys. But you'll find a document that summarizes all of the C to D movement rules and also shows you step by step with screenshots how to make your Fibs look like mine. See, sometimes people will ask me, well, your Fibs look different. All I'm doing, you'll notice I've got numbers above 0 as well. These are the Fibonacci extension. And the reason all the numbers are greater than 100, it's because this is how much further past B you've come. Okay, so 118%. 127, so forth. And based on the movement rules you've learned so far, based on what you're seeing on this chart, where C is, where would you expect D to be? Now keep in mind we're on or around about July 16th, right? Weeks before any of this happened. Where would you expect to find the top to this uptrend once it resumed? $138. Good for you, Tim. And look where we formed the top. In fact, not once, but twice. Okay? Overshot it by a little bit here, but hey, nothing's perfect. And Boyke, that's kind of what I'm saying in a way. It's like the fundamentals choose the direction, but the technicals are very good at determining how far in that direction. Okay? And certainly, you know, market situations can change from day to day. For example, we could say that on this day we had a bullish day. Maybe there was some good news. On this day we had a bearish day, but not bearish enough to break support. You know what I mean? And that gives you a clue that on the next day or two you might be going back up. As opposed to bearish on this day, which broke 2 support levels. You see what I mean? This is obviously more bearish than this. Whatever the news was that turned it down. So besides answering the question, how far, Fibs give us a very good way to measure the reaction to things. Okay? Bearish, but not bearish enough. We found support. You see what I mean? Run for the hills, bearish. Okay, the news creates the twists and turns. The technicals tell us how far is reasonable, Or how far is a change in direction? In Forex scale, yeah, that's not surprising that they would look different on a futures chart. Sometimes there's slight variations even from spot Forex broker to spot Forex broker. It really comes down to what the broker considers midnight. Or in other words, the close of the day, because these are daily candles. Okay, and particularly between Forex and futures, there's a big difference. Because the sort of unofficial, accepted end of the day for Forex, because keep in mind it's a 24-hour market. Right? So how do you mark the start and end of a day in a 24-hour market? Well, the world just gets together and picks something. And what they settled on was midnight GMT. But futures, depending where you trade them through, most futures contracts are settled in Chicago, either through the Chicago Mercantile Exchange or the Chicago Board of Trade. That stops trading at 4 p.m. Chicago time. So probably a lot of trading platforms then adopt 4 p.m. Chicago time as the end of the day when the daily candle prints. But here's the good news. There can be some variation on the daily chart, and by default also the 4-hour chart, because if midnight's at a different time, 4 a.m. is obviously going to be at a different time, 8 is going to be at a different time, right? It shifts everything. The good news is you can design a trading system that takes that discrepancy into account. For example, for me, the daily chart identifies what I call the window of opportunity. And usually it's not just Fibs alone. Those of you that come to my Wednesday class, you've seen I'll use moving averages. Sometimes I'll use pivot points. Okay, but window of opportunity, very simply, where am I going from? Where am I coming from? Where am I likely heading to? For example, on this particular day, my window of opportunity might be from 32.05, if we find support there, up to 32.86. That might be the window for this day. Okay? Then I'll usually go to the 4-hour chart, and if I'm thinking we're going to go from here to here, then I need to confirm that the current direction is bullish. And that's what I do on the 4-hour chart. I establish direction. So if the candle shapes are a little different, it's not that big a deal. I'm after the direction. Where I make my actual entry and exit decisions, ForexGal, is on the 1-hour chart, and that's precisely part of the reason. Because brokers in different countries might disagree about when midnight happens, but there's very, very few brokers, unless yours happens to be in Iceland, that disagree about where the top of the hour is. Iceland, a couple cities in Africa, and a couple cities in Australia use the half hour. But I've yet to find a broker from any of those cities, luckily. Most brokers agree where the top of the hour is. And that's where I need to make the critical entry-exit decision. And there's much less variation. Okay, because I mean, after all, you know, it was on around about July 16th that we identified our D target for early August. Okay, very few people are going to stay in one Forex trade for 2 weeks, but 3 weeks actually, right? Chances are you're going to break it down into smaller bite-sized chunks. The good news is Fibs are one tool that can help you to do that. So let's talk about the move down. And actually, this takes us into our next topic, what happens after you hit D? Well, one of two things will happen. You'll either establish D as the new support, which even though we were above it 3 times, we failed to do, right? We went above, we came back down. We went above, we came back down. We went above, we came back down. There's no firm test of the 138 as support, like there is here, for example. Here we're very clearly identifying a support level. Here we're identifying a support level. Okay? That never happened above the 138 level. Had it happened, anything beyond D, we just trade one fib level at a time. Okay? So next one would be 161, had we found a floor here. But I've got others beyond these even too. Bonus rounds. Exactly right, Janetta. There's a 200, there's a 261. There's even a, wait for it, 423. Okay, so there's plenty of room if this thing keeps running. I'm ready with my next several trades. But in this case, we didn't. We failed to find support. So I call that a completed Fibonacci pattern, or a concluded Fibonacci pattern. We've completed A, B, C, D. And there's nothing to indicate a bonus round. When a fib concludes, usually where you're going to return back to is either your 0% fib or your 21 exponential moving average, whichever one comes first. And lo and behold, we were lower than that when I started class, but as the day draws near to a close, look where we're heading back towards. And this is how for several weeks I've been coming up with the 3378 target. Okay? And those of you that have been coming to this class for a while, you can reassure the other folks I don't do my analysis only in hindsight. Okay, we were aware of this level well in advance of us hitting it. And the moment we hit it, I was telling you guys, if we find support here, 3484 is where we're heading next. If we don't, 3205. Right? Some of you guys, you can attest to this. 2 weeks ago when we were looking at this, I said next, 3205. It's not magic. This is how I did it. 9 out of 10 fibs. Thank you, Drew. Appreciate you backing me up. 9 out of 10 fibs, once they conclude, they return to zero. Or, like I said, if there's a strong support level along the way, such as the 21 EMA. So here we are at zero. Now usually, either at your 21 or at zero, you're going to have a bounce to the upside. Right? Because it's support. That's why we call it support. The cool thing is once I've a bounce to the upside, guess what? I've got enough information to draw my next fib. A, B, and that bounce up forms my C. Okay? So in other words, I'll go on to a new fib either when I reach zero of the old fib, when I see a newer fib in the opposite direction, or when I notice that my levels simply aren't snapping anymore. And as of today, let me zoom in on my hourly chart. As of today, well, we're still snapping. Which brings up another cool thing that I love about fibs, you guys. They're time frame independent. See? Look what we're doing now. We broke zero. We're retesting it from underneath as resistance before we go further. Look at the lovely snaps here. And here. I can go back further in the chart, show you even more. See that? I drew it on the daily chart, but look how useful it is on the hourly chart. This could be a trade, for example, Forex Gal. Double bottom on this fib, trade up to this fib. You don't know yet if you're going to go higher or not. Wait for a break and a retest from the other side. There's your next trade. Just for example. Hourly chart? Are you nuts? I never stay in a trade a whole hour. Yeah, how good are your results? I'm a scalper. All right, fair enough. Different strokes for different folks. Here's the 5-minute chart. I still haven't used my fib. Haven't moved it. Look at this. Wouldn't it be useful, look at this, wouldn't it be useful to know there's a support resistance level here? I'm using a daily fib, but it's finding all these congestion zones and important price levels pretty spot on. Okay? So time frame independent. I draw them wherever I see the zigzag. Then I go to my favorite time frame and I trade them from there. You're in the right place, Roy. I usually enter at market gibbons. Great question. Reason being, I might know that 3205 is an important price level ahead of time. But the thing is, I want to see how the market's behaving when I get there. Are my indicators starting to turn or not? Did we come down fast or did we decelerate as we approached it? I like to see things like that. They give me important clues. You know what I mean? If I'm absolutely no, I'm not going to be there, I might set a pending order, but it's not my preferred choice. I do set a pending order for stops and targets. If I don't know where my stop and target's going, I don't have enough information to enter the trade. That's my consideration. How can you calculate risk reward if you haven't picked the stop and target, for example? Not all entries are created equal. And this is one of the biggest things that separates human traders from robots. Emotion's the other, but with enough practice you can keep your emotions in check. But a robot, you see, takes every entry signal its system generates, regardless of the market conditions, regardless of the larger time frame context. We as humans can evaluate. I don't take all the entry signals my system generates. The entry signal's job is to draw your attention to the chart. Then I evaluate whether it's an entry signal worth taking. And risk reward is one of the ways I do that. What's my biggest risk, assuming worst case scenario and my stop gets hit? How much do I have to gain? A lot of people say that trading is like gambling, and it's true in that there's a random element. But that's where the similarity ends. Because you can apply techniques based on patterns that have occurred before and worked out much more often than they have, and because of risk reward, this is one part that people overlook. Yes, there's an element of randomness, but you can sway the odds in your favor. If people say trading is like gambling, my answer to them is yeah, but if you know what you're doing, you're the casino. Okay? And casinos make a buttload, don't they? Despite occasionally giving out a jackpot or two. The reason for that is because they understand risk, reward, and probability. If you make sure that your total potential profit is greater than your potential loss, or otherwise refuse to enter a trade, you're going to find yourself accumulating money over time. The losing trades will happen with any system, but they will tend to be much smaller than the winners. See, most beginning traders, the way they set themselves up, they get one or two lucky trades, they win a couple pips, but then they have a devastating loss that takes away all their profit and then some. And now you're in negative territory trying to claw your way back up. A casino would never even let themselves be put in that position. They set themselves up so that for every jackpot they give away, they're making 5 to 10 times the money somewhere else. You see what I mean? And therein lies the power of trading. A trading system is important, yes. But depending on your trading system's win rate, with ours we calculated, you can actually lose 3 times for every 1 win and still break even. In other words, 1 out of every 4 trades has to be right. That's not so tough. And anything above that, you're making money over time. So yeah, your system, your technique needs to be good, but the part people so often overlook is money management, probability, risk, reward. You can make your job much, much easier, or you can make it much, much harder. Not kidding. 1 out of every 4 trades right, you're already at break even. But the thing is, our system isn't right 25% of the time. Our system is right 75 to 80% of the time. Think about what that does to your account balance. Well, Drew, normally I would zoom in, like I said, on my hourly chart to look more closely. Normally there would be some other moving averages and things on this chart together with the fibs, but going just based on this chart, why not below the next support level? Right? If we're going up, in theory, support should bounce us up. So that might be one example for a stop. My general rule is I like to see 2 different support levels between my entry and my stop. And that can be a fib, a pivot, moving average, prior high, prior low. It's just simple logic, really. I don't like random numbers. Oh, I put my stop 20 pips away. I don't like that. Oh, should I put it 40 pips away? No, that's still a random number. You see what I mean? It might or might not be appropriate for a situation. And then I get the really sophisticated traders. Well, how about ATR, average true range? I'm like, okay, well now you have an elaborate and very complicated formula for picking a random number, but it's still a random number. I like support and resistance because it's always specific to each individual situation. If you're counting on going up, your floor should in theory bounce you up. If you're counting on moving down, anytime you have an up retracement, your ceiling should in theory bounce you down. And when it comes to setting stops and targets, by the way, you guys, never put them right on the line. If you see an obvious level, chances are other people have seen that obvious level. So I always set my stops a little bit wider, Drew, and I set my targets a little bit shy. An FX gal, that's also partially due to the fact that there's no central exchange, and there can be little variation from broker to broker. So set your stops a little wider, set your targets a little bit shy, and you account for those discrepancies. 200 simple moving average, that's another one, moving average that I really like. Absolutely. And yeah, once a level is in memory, Boyke, as a reversal point, absolutely. People become cautious of that level. Not everybody uses fibs. Some people might plot a horizontal line at the prior reversal. Some people might just do a visual check and see where the prior high or low is. Once a reversal happens at a level, yeah, we tend to come back to them again and again. Markets have memory. Absolutely. Do I hold my positions overnight? It depends. If there's a compelling reason to, I might. If there's not a lot of news due out, I would need a good reason. I usually hold commodities several days, sometimes several weeks at a time. Forex, usually I trade intraday, which means I'm in and out the same day. But there's been exceptions. I certainly don't like to hold Forex over the weekend, that for sure. Too many gaps. Simple as that. Remember, your stop is not the price you're going to get out at. Your stop is the level at which your pending order becomes a market order. and it is then executed at the best possible price. So if there's a gap, you're going to be closed on the other side of the gap, not at the price you set. And the thing with gaps is usually they get filled. If there's a Friday to Sunday gap, usually late Sunday night, first thing Monday, first thing you do is close the gap. So not only are you going to be frustrated that you got stopped far away from where you set your stop, but you're going to find price much closer to your actual stop when you wake up in the morning. That's like putting lemon juice on the cut. So weekends usually not. Other nights, it depends how compelling it is and how little news there is expected overnight. Good thing is you know what news reports are scheduled and when they're scheduled to hit. And if you don't, go to fxnight.com. We've got a convenient economic calendar right on the homepage you can use. Mr. Morrison, how do I determine my entry trigger? Well, as I mentioned, I use a couple other indicators. And also some moving averages together with the Fibs. I don't trade them purely naked. But if you were using nothing else, a good entry point might be breaking the next resistance level, retesting it as support. Because how else do you know that a reversal happened? Then you go higher. Okay, so just trading purely naked, this might be a good entry. I add some other indicators, I might be able to nail it closer to C. What I encourage you to do, it's a topic that goes beyond the scope of just this class. So there's a couple different entry variations possible, but join us next Wednesday on our institutional trading strategies class, because that's where I go into much more detail about some of the other indicators that I use to confirm the Fibonacci signals. Could you have made a new fib with D as the new A? You could have, Drew, but the thing is your retracement would be greater than 100%. Any retracement greater than 100% is a reversal. No longer a retracement. So you could have, but it would have been canceled out. That's why we're waiting for a new one here. Recent rule, just because markets have been so choppy and antsy lately, they tend to overreact to the smallest, most insignificant pieces of news. Not surprising, 2008 spooked people quite a bit. So I prefer to break it into bite-sized chunks because of how erratic it is. Why sit through this down move? I could be a bear during this down move. For example, let me put the Fibs back up. You see where support resistance is? Once I see a reversal, on this particular day, I could be a bear and then become a bull again the next day. So I found it's more profitable to split it up. Commodities tend to have strong multi-day trends, so that's where I tend to take much more position type positions. Position type positions. Yeah, you know what I mean. But the thing is, what is positional trading anyway? I'm stubborn. I'm going to stick to my idea no matter what happens. Nah. If there's a reversal, I'm going to change my mind and go the other way. That's how I operate. Sometimes that means very, very short trades. Sometimes that means slightly longer trades. All right, I promised you guys we would take a look at gold. I want to show you that this isn't just for Forex. I use it on stocks. I use it on commodities. It'll move on anything. It'll work on anything that moves, really. You know, everybody was so bearish on gold. People were saying we were going to see price in the 900s when this thing was dropping. I was telling people we would go down to 1245. Some of you that have been coming to class long enough will remember that. I also revised my downside target down, but notice when I did that, we broke 161, we retested it from the other side as resistance. Bonus round, down to the next fib level, which in this case was 1188.15. Okay, so we trade the part we know. If there's a break retest, that's bonus. That's a separate trade. And this is what I was saying. Eventually, once you start reversing and going in the opposite direction, you'll form a fib to the other side. And actually, I did this one. We did it this way at first, and while we get some snaps, I think you get better and more snaps doing it this way. Okay, now look what I did. There's two potential point A's. Okay, there's very little question over where to put your B. There's just one top. Okay? But there's two potential places to put your A. Usually, most of the time, it's going to be your most recent one. Okay? The classic definition for fibs, you guys, it's most recent low to most recent high. Or in a downtrend, most recent high to most recent low. Now here, the most recent one, there was also another one back here. The most recent one also happened to be the highest one. Okay, well, little decision to make there. In this case, the most recent one isn't necessarily the lowest one. But as I'll show you in a minute, it's not overly critical. It works better and more precisely if you use the most recent one. But look at it. If you draw it this way, we had a 50% retracement. 50% retracement gives us a D where? See if you guys remember. 50% retracement goes to where? 161. Excellent, Tim. Look where we reversed. Where are we likely headed next? What happens if you don't get a bonus round? Zero. Okay? Provided, notice how we came back up, provided 1401 doesn't hold as support, right? If it holds as support, we go up to the next resistance level. But assuming we close below this level, yeah, over the next several days, I would expect us to work our way down to 1347. Unless we hit the daily 21 first. Okay, daily 21 EMA. Sometimes we hit the daily 21 and we keep going. That might result in two separate trades. And talking about your question of entries, here again, it would be fine-tuned with other indicators, but just going off of the naked chart, one potential entry could be if 1401.02 holds as resistance from underneath. We've already broken that level. We've come back up to it. Look at it on the hourly chart. If this now holds as resistance and we open below it, that might trigger a short entry. Okay, though usually not at this time. I usually don't like to initiate new trades towards the end of the day. Okay, but that's one potential trigger for an entry. So what if we had used the other A? Well, look at this. In that case, the levels get a little wider apart. Now your C lands on 38 instead of 50. Shallower C means a shallower D, but your levels are wider apart. So this ends up being a 38 to 138 trade. Ta-da! That's the magic of Fibs because they are based on ratios. And now we're just bouncing back and forth between two of the Fib levels. Why'd I say the other Fib was better? You didn't leave quite as many pips on the top. Don't get me wrong. Sum total of all your trades would be 1,240 pips. I'm sure if you just bag 1,200 pips, you're not worried about the last few. This isn't a bad trade, but when you get more snaps on the in-between levels, you tend to get more precision by the time you get to your D. When A was at the top, let me check it. C is 50. So that's a 50 to 161 trade. The bonus round is because you broke 161 and retested it as resistance. Cardo, you were asking how do we trade the bonus rounds? When your original D target breaks and retests from the other side. The retest is critical. Look at how many times we broke this resistance level. Look at all these wicks. How many of them actually resulted in a higher close? Only one. Look at how many times we broke this resistance only to go down. So I don't put a lot of weight in breaks. It's got to come back up and retest from the other side. Then it's a valid break in my book. Daily 21 EMA, correct, Cardo. Also a valid target. It's whichever comes first. And just like with the bonus rounds, if the first one breaks and retests, then I go to the second. Whichever one comes second then, the 0% fib or the 21. The cool thing is 9 out of 10 times you're going to end up bouncing between the 0 and the 21, which is what creates the counter move for your next fib. Ta-da! It depends on preference, Bob. I like the 1 hour chart. That's my favorite. It's the one I recommend most of my students start out on till they get consistent. Doesn't mean you have to stay on that chart for life. But it's got a good signal to noise ratio. You can always look lower afterwards, but here's the thing. If you then go down to the 15-minute chart and your results suffer, there's no point in even trying the 5-minute or the 1-minute because they're not going to improve the lower you go. There's more noise, so you can expect more errors. Most people are doing it the other way. They start on the 1-minute chart and they tell themselves when they get good, they'll graduate to the 5-minute chart. You're making it hard on yourself again. Higher is better. Most of my students, once they complete their consistency period on the hourly chart, they actually end up going higher rather than lower in time frame. Just FYI. More pips with less work. Risk reward on a trend following trade like this, Dhruv, I like to see 1 to 3. 3 times more reward than risk. On a range trade, it sometimes might be 2 to 1, but I will never take a 1 to 1 trade. Because at that point, you've got 50-50 odds. That's gambling. I like casino odds. Alrighty, you guys, so that's Fibs in a nutshell. I hope this has been useful. What I want you to do over the weekend, pull up some of your favorite charts. Practice spotting that zigzag. Practice drawing your fib. Doesn't have to be on the daily chart, by the way. Sometimes you see it on the weekly. Sometimes you see it on the hourly or the 4-hour. Just go through your time frames, look for a zigzag, draw a fib. Then zoom in on your preferred trading time frame and observe how price behaves relative to that fib. Okay, here's some links for getting in touch if you want to follow up. First one is for a daily newspaper we publish every morning at 8 GMT. Totally free, you guys. And you can subscribe to get it in your email box or on your Twitter account. Here's my Twitter, my Facebook. As I mentioned, we only covered one indicator today, not a complete system. If you want to learn the complete system, join us for a Wednesday class. We look at some of the indicators. If you don't like getting your things in pieces, learn the whole system, start to finish, A to Z. Not just A, B, C, D. Second link links you to our online workshops. They're recorded. You can watch them at your convenience. If you want to take it a step further, we do 2 live sessions every single day. At the start of the European session and when we get into the second half of the U.S. session. We set up our trades for the day. We do a daily wrap-up to see which ones worked out, why or why not. You think 45 minutes together taught you a couple things. Imagine doing it twice a day, every day, on live markets. That's what we do. If you're short on time or short on money, we have our budget program, what we call the weekly video updates. This is where we send you a recording. You can't interact or ask questions, but we send you a recording of the Monday morning videos. Why the Monday morning one? Because that's where we set up our scenarios for the week ahead. So at least you're not trading blind. And at the very minimum, stop by and say hello at fxnight.com. We've got tons of free tools for you as well. Okay, training's the only thing we charge for. Tons of free tools. I mentioned the economic calendar. We got a free chat room, free forum, free plugins and indicators you can download for MetaTrader, all sorts of goodies. And while you're there, please take a moment to sign up for our mailing list. We're not going to spam you. We send out 1, maybe 2 mailings a month. Usually it's to let you know about another webinar like this one. All right, so thank you guys very much. Appreciate your time and attention. Wish you a wonderful weekend and hopefully a little more profit next week using some of these techniques. We'll see you guys on Wednesday.